Welcome to the Seatrade Maritime Podcast. In the third of our bonus episodes for the half-year markets outlook, we focus on dry bulk shipping with Maritime Strategies International. I'd like to move on to the dry bulk market with the views of Plamen Natzkoff. Plamen, welcome back to the podcast.
Hi, Marcus. Thank you for having us back.
Great pleasure, and thank you for taking the time to talk to our listeners. Dry bulk has performed somewhat better than it has in the last couple of years. What's been behind this renewed optimism and better performance of the markets this year?
You're absolutely right. The dry bulk market has had a very good first half of the year in general. We do have to differentiate between sectors, however. If we look at the performance of the different sectors, obviously they're driven by different factors, and this is also translating in somewhat differentiated performance. So if we look at the smallest end of the spectrum, the handy-size market, they're only about 20-25% up year to date on the rates of last year. The Supramax Panamax are about 30-35% up on last year. The real standout performer has been the Cape market that has almost doubled on what it has done in the first half of last year. It is important to note those differences because there are significant differentiating factors in the underlying commodities flows that these vessels are mostly responsible for. So we can point to, for example, on the Capesize, we had a great first quarter and really second quarter for the iron ore trade. We are running at about 20 million tons up on last year, and the majority of that, 3/4 of that, is coming from Brazil. So that Brazil to China long haul route is really helping. Similarly, supporting the Capes, we've had the bauxite trade out of West Africa up around 10-11 million tons year to date. And that, of course, is a long haul route going to China. By contrast, those commodities that typically fill up the smaller vessels, they've been under somewhat of a pressure. So if we look at coal, some into Capes, but mostly in Panamax and Supramax, the coal trade is actually down year to date by around 20 million tons. So that clearly provides a differentiating factor in terms of the performance of the different vessel sizes.
Okay, so it does vary by market then and cargoes. In terms of what you've seen in the first half, how do you see this carrying through to the second half of the year, and where is the market headed?
Very good question and very timely question given we're at the midpoint of the year. Typically, what we see is commodity volumes generally pick up through the end of the third quarter and into the fourth quarter. And this is really driven by iron ore and coal trades and then the grains trades as well. We see no reason for a break in that seasonality this year. Now, assuming that, clearly that would suggest further strength, continued strength in the dry bulk market through the next 6 months. As we have discussed so far, in the context of the container market, disruptions have been of prime importance to the overall supply-demand balance in the freight markets, and the dry bulk is no exception. Now, in terms of the dry bulk, of course, we're starting to see the Panama Canal get back to normal transiting levels. So that would take some of the heat of those Panamax typically would use that. And again, other than away from the seasonal strength that we see going forward in some of those commodities, so much will depend on what happens to the Red Sea, which has had a tremendous impact on the dry bulk market and especially on the Capesize segment. It is no coincidence that the handies, which are typically less involved in those routes, have underperformed relative to the other sectors. Overall, fundamentally, if we do not get a relief from canal disruptions, we should expect continued strength through the rest of the year. But again, probably a volatile market depending on what happens to the Red Sea.
So dependent on external factors again. What's happening on the supply side in terms of fleet development and new buildings?
So new buildings, clearly the stronger freight rate environment has had two main effects. One, it has discouraged the scrapping of vessels, the demolitions of vessels. This is across the vessel sizes. So with that in mind, the fleet is getting relatively older, but given prevailing freight rates, owners are incentivized to keep those vessels on the water. The other impact, of course, is on vessel values, vessel second-hand prices. Those have continued to climb, reaching for a benchmark 5-year Capes, reaching probably around 60 million in some cases. So that has in turn encouraged some owners, some players to actually enter the new building market as well, adding to the order book. So if we look several years ahead, we still see the orders that have been placed recently, expanding the size of the fleet. And of course, yards have been performing so far this year. This year, we expect around 25 million deadweight tons of new deliveries. So we will end the year with a significantly larger fleet than we started the year. And then, given the new building program that several owners are embarking on, those deliveries will continue in the years ahead. And again, much will depend on underlying trade flows and, of course, geopolitical disruptions going forward.
So we are seeing that sort of return of ordering. Then that sort of whole factor, of the geopolitical tensions and what happens next. Look forward to coming back to you in 6 months' time and seeing where this has gone to. And it's good to see some positive signs in that market and things faring a bit better overall. If you've enjoyed this episode of the Seatrade Maritime Podcast, make sure to subscribe on the app of your choice. And we look forward to joining you on the next episode.